All right, so we are going to dive into examples for Chapter 7 in this PowerPoint. So the presumption is that you've already listened to the Chapter 7 lecture. If you have not, the recommendation would be to do that first and then come back and listen to this one. All right, so exercise 7.1. Vail Company recorded the following selected transactions during November. They want us to prepare a general ledger having T accounts for account receivable, sales, sales returns, and allowances. And then also open an accounts receivable subsidiary ledger having a T account for each customer. Post the entries to both the general ledger and the accounts receivable ledger. Okay, so here's all the transactions from the previous slide for our reference. We have our T accounts there. We're going to begin to post all of our debits to the left side of the applicable T accounts and the credits to the right side. So there you have your accounts receivables and your sales. But we also need to post that to the subsidiary ledger for Ski Shop, right? Then we have our next accounts receivable transaction and sales posted to their T account, right? Then November 13th, we have another sale posted to their T account. Then on November 21st, we have a sales return and allowance from Zia Natara. So we're going to record our debit to our T account there on the left side. We're going to post our credit to the accounts receivable on the right side, but then we also need to post it to the T account for the customer, Zia Natara. In our last transaction, November 30th, got our accounts receivable Ski Shop, so it has to go to the accounts receivable general ledger, but then also to the subsidiary ledger, right? So we have a balance of $9,301 in receivables, balance of $9,510 in sales, balance of $209 in sales returns and allowances. That's our contra revenue account. Ski Shop owes us $7,328. Welcome Enterprises owes us $1,350, and Zia Natara owes us $623. Okay. So if we prepare a schedule of accounts receivable, all we're doing is listing the customer name and the balance. Total matches your accounts receivable balance of $9,301. All right, so same idea here. Why don't you pause the recording? Post your activity to your T accounts and to your subsidiary ledger accounts, and when you think you're finished, resume the recording and we will go through it. All right, so there's all of our activity. There's our T accounts, so we start to post. Debits to the left side, credits to the right side. Post our debit to Ski Shop. Next transaction, November 10th, debit receivable credit sales. Post to Welcome Enterprises, $2,081. Next transaction, debit receivables, credit sales. Post to the left, post to the right. Post to the left side of the T account for Zia Natara. Then we've got a sales returns and allowance from Zia Natara, right? So we debit sales returns and allowances and post that to the left side of our T account. Credit accounts receivable and post that to the right. And then we post that to the right side of the Zia Natara subsidiary ledger, right? Our last transaction, post to accounts receivable and sales, and then it gets posted to the subsidiary ledger for Ski Shop, right? Sum up all of our balances. How'd you do? So if we prepare a schedule of our accounts receivable balances by customer, you just list the customer name and the balances, right? And the total should match your accounts receivable general ledger account balance of $14,694. All right, exercise 7. The Levine Company uses a perpetual inventory system and allows its customers to use 2 credit cards in charging purchases. SunTrust Bank Card, 4% service charge, and Continental Card with a 2.5% service charge. So on April 8th, they sold merchandise for $8,400 that had a cost of $6,000, and they accepted the customer's SunTrust Bank Card. So SunTrust Bank Card, say that 10 times fast, has a 4% service charge, right? So we're going to record our sale for $8,400. We're going to record our credit card expense, which is our $8,400 times the fee of 4%. We're going to record cash for the net, $8,064. Then we also need to record the cost of the goods we sold, right? So cost of goods sold, $6,000, they tell us, and reduce our inventory by $6,000. Then on April 12th, we sold merchandise for $5,600 that had a cost of $3,500 and accepted the Continental Card. So we record our sale of $5,600. Continental Card charges a 2.5% fee. So credit card expense is going to be $5,600 times 0.025 or $140. Cash for the difference, right? Then we also have to record the cost of the goods we sold. So we're going to debit cost of goods sold for $3,500, and we're going to credit merchandise inventory for $3,500. Okay? So same problem, different numbers. Why don't you pause the recording, work your way through it, and when you're finished, you can resume the recording, and we'll go through the answers. All right, so April 8th, we sold merchandise for $4,200. Credit sales, $4,200. The card they used is the one that charges a 4% fee, so we're going to take $4,200 times 4%, and we're going to debit credit card expense for $168. Then the net is our cash. We need to record the cost of our goods that we sold, so we're going to debit cost of goods sold for $3,100 and credit merchandise inventory for $3,100. Then on April 12th, got sales of $2,000 using the card that charges 2.5%, so $2,000 times 0.025. The net gets booked to cash. Okay, so they made a sales of $2,000, but because the customer used a credit card, they're only going to collect cash of $1,950, right? Then we have to record the cost of the goods we sold, so we're going to debit cost of goods sold for $1,500 and credit merchandise inventory. All right, so hopefully you found that to be pretty easy. Let's move on to the next. So exercise 7.3. So Zmart uses the perpetual inventory system and allows customers to use the Zmart store card in charging purchases. Zmart assesses a per month interest fee for any unpaid balance on its store credit card at the end of each month. So on April 30th, they sold merchandise for $1,000 that had cost of $650 and accepted their own store credit card. So we're going to record an account receivable for $1,000. We're going to record sales of $1,000. We're going to record cost of goods sold of $650 and merchandise inventory. We're going to reduce our inventory for the $650 worth of stuff we sold. So on May 31st, Zmart recorded $4 of interest earned from its store credit card as of the end of the month. Accounts receivable, $4, and interest revenue, $4. Okay. All right, so same problem, different numbers. Why don't you take a try at this one, and when you're done, you can resume the recording and we will go through it. All right, so Zmart sold merchandise for $4,000 on their company credit card, so we have an account receivable of $4,000 and sales of $4,000. There's no fee to record because they're not using some bank card, right? That's where it differs from the other one. Then we have to reduce our inventory and record the cost of the goods that we sold. So we're going to debit cost of goods sold for $1,650 and credit merchandise inventory to reduce it for $1,650. Then on May 31st, we have to record $24 of interest that we've earned from our store credit card, right? But haven't yet been paid because our balance on our store card hasn't yet been paid. So we're going to record an account receivable for $24 We're going to record interest revenue for $24. Okay, so hopefully you did well on that one. Let's move on to the next one. 7.4. All right, so Dexter Company applies the direct write-off method in accounting for uncollectible accounts. They determine they can't collect $45,000 of its accounts receivable from its customer Lester Company. So so we need to record the write-off on March 11th. So $45,000 is currently sitting in the accounts receivable for Lester Company. So we need to record bad debt expense, and we need to debit or credit Lester Company's accounts receivable for $45,000. Take it off the books. Okay. Then Lester Company unexpectedly pays us the full balance. So we have to reverse the write-off first and then record the collection of the cash. So to reverse the write-off, we're going to put the account receivable back on our books. So we do that with a debit. We're going to reverse the bad debt expense with a credit. Then we're going to record the collection of the cash and the reduction of the receivable. Okay. So now we have a balance of 0 again in our accounts receivable, but we've collected the money. All right, so same problem here. Why don't you take a minute and see if you can't write out those entries, and then when you're finished, you can resume the recording and we can go through it. All right, so on March 11th, Dexter determines it can't collect the $8,500 that's sitting in its accounts receivable account for Lester Company. So we're going to debit bad debt expense and credit the accounts receivable for Lester Company. Then on March 29th, they figure out that Lester Company's unexpectedly paid them. So we need to reverse what we wrote off, debit accounts receivable, credit bad debt expense, right? Then record our cash. Debit cash, credit AR. Okay, so hopefully you've done well on that one, and you can see here your T account is now back to 0 again. All right, exercise 7.5. At year end, December 31st, Chan Company estimates its bad debts to be 0.5% of its annual credit sales. That's $975,000. They record its bad debt expense for that estimate. Then on the following February 1st, they decide that $580 account of P Park is uncollectible and they write it off. On June 5th, they unexpectedly pay. So they want us to prepare the journal entries to record these transactions and events of December 31st, February 1st, and June 5th. So, Chan Company estimates their bad debts to be 0.05% of their annual credit sales. So 975 times 0.005. Bad debt expense, debit, and we'll credit allowance for doubtful accounts. So if we're going to estimate based on sales, the income statement approach, we have 975,000 of sales, right? Bad debt expense needs to be 0.05%. So 975 times 0.05 is 4,875. We started at 0. So our adjustment's going to be $4,875 debit to bad debt expense, and the other side goes to the allowance. That was a long way and a lot of clicks to get to that point, but hopefully you followed me. Then on February 1st, they decide that a $580 account of P Park is uncollectible. Well, they've already recorded the bad debt expense, right? So they're just going to reduce their allowance and reduce their AR. So you're going to debit allowance for $580 and you're going to credit accounts receivable for P Park for $580. Then on June 5th, we got paid, so we have to reverse what we wrote off. So it's just the opposite of the entry from February 1st. And then we record the cash we collect. Debit cash, credit accounts receivable for P Park. Okay. All right, so same problem here. Why don't you take a few minutes, give it a try, and when you're finished, resume the recording and we can walk through it. All right, so bad debt expense and allowance for doubtful accounts under the income statement approach. We have $852,000 in sales in this problem, and we want bad debt expense to be 1% of sales. So 1% of 852,000 is $8,520. We started at 0 in our bad debt expense. We have an adjustment of $8,520. Debit bad debt expense, credit allowance. Then on February 1st, they decide that a $426 account of P Park is uncollectible. We're going to write it off. We've already recorded our bad debt expense, estimated it. So all we're doing is reducing our allowance and reducing our accounts receivable account, right? So we're going to debit our allowance for doubtful accounts for $426, and we're going to credit accounts receivable for P Park, $426. Then on June 5th, P Park unexpectedly pays us. So we have to put back the balance before we can record the collection, right? So you just reverse your entry, and then you record your cash. Debit cash, credit accounts receivable. Okay, so hopefully you did well on that one. Let's move on to the next. Exercise 7-6. At each calendar year, Mays Supply Company uses the percentage of accounts receivable method to estimate their bad debts. On December 31st, they have outstanding accounts receivable of $55,000, and they estimate 2% will be uncollectible. So prepare the adjusting entry, and we're going to assume that the allowance for doubtful accounts has a credit of $415 before the adjustment. So 2% of 55 is going to be what we record to our bad debt expense, right? So estimate based on receivables approach, we have $55,000 in our accounts receivable. Our allowance needs to be 2% of $55,000. We started with a credit of $415, so what's the adjustment? $685, right? 2% of 55 is $1,100. We started with $415. We need an additional $685 to get to the balance that we want. Okay? Okay, so this is the same problem. The only difference is that instead of having a $415 credit balance, we have a $291 debit balance. So again, our entry is going to be debit to bad debt expense and allowance, credit to allowance for doubtful accounts. But this time, we still have $55,000 in accounts receivable, and we want 2% to be our allowance. So that's $1,100. But this time, we're starting with a debit balance of $291. So to get from a debit balance of $291 to a credit balance of $1,100, we have to add, right? So $1,391 less $291 is a credit balance of $1,100. So that's going to be our journal entry: debit $1,391 to bad debt expense and credit $1,391 to allowance for doubtful accounts. And our balance sheet presentation would look like this: accounts receivable 55 less allowance for doubtful accounts of $1,100 equals a net receivable of $53,900. All right, so same problem here. Why don't you take a moment and see if you can't figure this out on your own, and then we can resume and go through the solution. All right, so this time, Mays Supply Company has outstanding receivables of $133,500, and they estimate that their bad debt should be 4%. So $133,500 times 4% of $133,500 is $5,340. They start with a credit balance in their allowance of $2,270. So we've got a $2,270 credit. We need to get to a $5,340 credit. So we're going to do that with a credit of $3,070. So we're going to debit bad debt expense for $3,070 and credit allowance for doubtful accounts for $3,070. All right, then still the same problem, but this time we're starting with a $688 debit balance. So why don't you take a moment, see if you can't figure out what the journal entry should be, and then we can go through the answer. All right, so bad debt expense, debit, credit, allowance for doubtful accounts. But to figure out the amount that we need for our journal entry, This time, we are starting with a credit or a debit balance, excuse me, and our allowance for doubtful accounts of $668. So if we have a debit of $668, we need to get to a credit of $5,340. What adjustment do we need? We need a credit balance of $6,008 less our debit of $668 equals our net of $5,340. Okay. So hopefully you've done well on those. And then our balance sheet presentation here. So we have a $133,500 less our allowance of $5,340. So we have a net receivable of $128,160, right? All right. Exercise 7-7. So Daly Company estimates uncollectible accounts using the allowance method.
Oh my gosh.
Oh, the children are home from Halloween. Please hold. All right, so I'm not sure where I was before my sugared up stepchildren came through the front door. So, all right, back to business. Daly Company estimates uncollectible accounts using the allowance method at December 31st. It prepared the following aging of receivables analysis. So they want us to calculate the balance of the allowance for doubtful accounts using the aging of accounts receivable method. So in order to do that, right, we take each bucket times the percentage. So not due, 396 times 1%, 3,960. 1 to 30 day bucket times 2%, 31 to 60 day bucket times 5%, 61 to 90 day bucket times 7%, and the over 90 bucket times 10, right? So our estimated balance for the allowance for uncollectibles should be $11,820. So that's what we want our credit balance to be, right? So we've got $570,000 in our accounts receivable. We have an allowance for doubtful accounts that we want to be $11,800. So what's the balance equal? They tell us the balance is equal to a $3,600 credit. We want it to be that $11,820, right? So debit bad debt expense and credit allowance for doubtful accounts for $8,220. So then we have our balance sheet at $570,000 less our allowance of $11,820 equals a net receivable of $558,180. Our bad debt expense on our income statement is $8,220. Okay, so in part C, they want us to prepare the adjusting entry to record the bad debt expense using the estimate from part A, but assuming the unadjusted balance in the allowance for doubtful accounts is, this is incorrect, is a $100 debit. DR stands for debit, okay? Yes, why there's an R, I don't know, but that's true statement. Okay, so the unadjusted balance in the allowance for doubtful accounts is $100 debit balance. So our account equals $100 debit. It should equal that $11,820. So what's our adjusted entry? We need $11,920 of credits less $100 of debits to get $11,820 of credits, right? So we're going to debit bad debt expense for $11,920. We are going to credit allowance for doubtful accounts for $11,920. Okay. Then our balance sheet will be $570 less $11,820. Net of $558,180, and then we have bad debt expense of $11,920. All right. Now you get a chance to calculate Daly Company's estimates for their uncollectible accounts using the allowance method. Okay. So calculate the estimated balance of the allowance for doubtful accounts using the aging of accounts receivable method. So why don't you pause the recording, take a stab at it, and then resume the recording and we'll go through the answer. Okay, so again, each bucket times the percentage, right? Easy peasy. All right, so we're just taking each of the balances in the buckets times the percentage that they think is going to be uncollectible, and then you add them up. So that's an estimated balance of allowance for uncollectibles of $16,200. Then we have a balance in our accounts receivable of $700,000. We have an allowance for doubtful accounts that needs to be $16,200. So to prepare the entry, what does our balance equal? They tell us that we start with a credit balance of $1,200. It needs to equal $16,200. So we need an adjustment of $15,000. Credit allowance for doubtful accounts, debit bad debt expense. Right? Then there's our balance sheet presentation and our income statement, bad debt expense. All right, in letter C, rather than assuming that we have a starting balance of a credit, what if we had a debit? What's our adjustment? $16,700, right? You have a $16,700 credit less a $500 debit for a net balance of $16,200. And then there's our balance sheet presentation. Okay, so hopefully you did well on those. Let's move on to the next. Exercise 7-8. So again, Dally Company estimates uncollectible accounts using the allowance method. And this time, they use the allowance for doubtful accounts, assuming the company uses a 4.5% of total accounts receivable to estimate uncollectibles instead of the aging of receivables method. So we have accounts receivable, $570,000, allowance for doubtful accounts at 0.45% of that. So prepare the adjusting entry to record the bad debt expense from A. So we have a $12,000 starting balance. $25,650 should be our credit balance and our allowance. That was the total receivable bucket times 4.5%. For a total unadjusted balance of $25,650, or adjusted balance, sorry. So to get to $25,650, when you start at $12,000, you need a credit balance of a credit adjustment of $13,650. So we have allowance for doubtful accounts of $13,650 credit, bad debt expense $13,650 credit. Then our presentation on our balance sheet. Accounts receivable less allowance for doubtful accounts equals your net receivable. And then there's your income statement, your bad debt expense of $13,650. Now, instead of starting with a debit or a credit balance, they said, well, what if you start with a debit balance in your allowance of $1,000? And you need to get to $25,650? What adjustment do you need? $26,650, right? So that's a debit to bad debt expense and a credit to allowance for doubtful accounts of $26,650. There's your balance sheet presentation and your income statement presentation. Okay. All right, your turn. Same idea here. They're using the total aging or total accounts receivable method rather than the aging. So, why don't you pause the recording, give it a shot, and then you can resume the recording and we'll go through the answer. All right, so we have 700,000 of accounts receivable. 3% of that suggests that we should have an allowance of 21,000. So, to prepare the journal entry, if we're starting with a unadjusted balance of $10,000 credit and we need to get to 21,000, what do we need? Debit or credit, and how much? That's right, $11,000 credit balance to your allowance for or credit adjustment to your allowance for doubtful accounts. So credit allowance for doubtful accounts for 11,000, debit bad debt expense for 11,000. There's your receivable side, 700,000 less your 21,000 allowance. And there's your income statement side. Okay? Assuming that the unadjusted balance is a $2,000 debit to start. Now what adjustment do you need? $23,000, right? $23,000 credit less a $2,000 debit is a $21,000 net credit. So we're going to debit our bad debt expense for $23,000 and we're going to credit our allowance for doubtful accounts for $23,000. And there's our balance sheet side and our income statement side. Okay, hopefully you did well on that one. Exercise 710. So, at December 31st, Folgers Coffee Company reported the following results for its calendar year. Its year-end unadjusted trial balance includes the following items. So they want us to prepare the adjusting entry to record bad debt expense, assuming uncollectibles are estimated to be 3% of credit sales. So, what's the balance equal? It's 0 right now. What should it be? $900,000 of credit sales times 3%. Oh gosh. Let's make that. This is cash money. This is credit. They have it backwards up here. All right, so then assuming that our credit sales are 900,000, not our cash sales, 900,000 times 3%, $9,000. So in order to get our bad debt expense from 0 to 9,000, we need a debit of $9,000 and credit allowance for doubtful accounts for $9,000. All right, so assuming it's estimated to be, the only thing different here is assuming it's estimated to be only 1% of total sales. So here we have 0. But bad debt expense is estimated to be 1% of total sales in this scenario. So 1.2 million times 1% is $12,000. So in order to get from 0 to 12, you debit bad debt expense for 12. And you credit your allowance for doubtful accounts for 12, right? Alright, so then in letter C, it says to prepare the adjusting entry to record the bad debt expense, assuming uncollectibles are estimated to be 6% of the year-end accounts receivable balance. So the year-end accounts receivable balance is $125,000 debit, right? So $5,000 is our current balance and our allowance, but it needs to be 6% of 125,000. So 125,000 times 0.06 is $7,500. To get from a debit of 5 to a credit of 7,500, you need a large credit, right? 12,500 less the debit of 5 gets you to a net of 7,500. So you have bad debt expense, debit for $12,005, and allowance for doubtful accounts, credit for $12,005. There's your bad debt expense side. There's your ending balance. Okay, so same problem here. We'll pause after each A, B, and C because they're not all on one slide. But so why don't you take a minute and prepare the adjusting entry for bad debt expense, assuming that uncollectibles estimated to be 6% of credit sales. Okay, so step 1, determine what the account equals. Bad debt expense is currently 0. What does it need to equal? 6% of credit sales, or $5,000, right? So to get from 0 to $3,000 in bad debt expense, do we debit or do we credit? Debit, right? So you debit $3,000 and you credit your allowance for doubtful accounts for $3,000. All right, part B, why don't you take a minute? See if you can't compute the journal entry for this one. So the difference here is we're assuming that bad debts are estimated to be 1% of total sales. So our balance currently equals 0, and our balance should equal 1% of the total sales, which is 1.4 million. So that's $14,000, right? To get from 0 to $14,000 in bad debt expense, we debit and we credit our allowance for doubtful accounts. All right. Letter C, why don't you take a minute and try to figure this one out? So this time they want us to estimate the bad debt expense, assuming it's 4% of the year-end accounts receivable. All right, so first step is to determine what the balance equals, which is 0, or I'm sorry, 2,000 in our uncollectible account. Here's our debit right here, $2,000. It needs to be equal to 4% of the year-end accounts receivable, so 150,000 times 4% is $6,000. So to get from a debit balance in our allowance for doubtful accounts to a credit balance of 6,000, we need a credit of 8,000, right? Credit of 8,000 less debit of 2 equals net credit of 6, okay? So we're going to debit our allowance for doubtful accounts by 8,000 and we're going to credit bad debt expense by 8,000. All right, exercise 711. So in this transaction, they want us to prepare the journal entries of Danica Company for 2017. So on December 13th, they accepted a $9,500 60-day note at 8%, dated December 13th from Miranda Lee, and granting time extension on her past due account receivable. So the principal is $9,500, the rate is 8%, the time is 60 days. So our total interest is going to be 9,500 times 8% times 60 divided by 360. So the total interest for the entirety of the note is $127. So at December 31st, if it was on December 13th that we extended the note, we're going to have 9,500 times 8% times how many days between the 13th and the 31st? 18? 18 days divided by 360, so the interest accrued at December 31st is $38, right? So the interest recognized on February 11th of 2018, it's going to be our 8% times the remaining 42 days divided by 360. So we're going to recognize $38.17 and we're going to recognize $89 of that $127.18. So on December 13th, we're going to record our note receivables. Note receivables an asset. You increase assets with debits, right? And we're going to get rid of her account receivable because they're granting the note in exchange for past due accounts receivable. So we're going to take the accounts receivable balance to 0 and we're going to record a note receivable instead. That's what that first entry is doing. Then on December 31st, we have to recognize the accrued interest, which we already calculated above for 18 days. So we have interest receivable of $38 and we have interest revenue of $38. Okay? All right, same account or same problem, just different numbers. So why don't you take a few minutes and see if you can't figure out the journal entries for this one, and when you think you're finished, you can resume the recording and we will go through the answers. All right, so on December 31st, when we grant the note, we're going to record a debit to notes receivable and a credit to account receivable because we're going to relieve her account receivable that's past due and we're going to give her a note instead. Okay? Then our interest for 18 days is going to be the $15,000 times 9% times 18 divided by 360, which is $68. We're going to record our interest revenue for $68, right? So hopefully you did well on that one. Exercise 712. So in this exercise, they want us to prepare the journal entries for the following transactions for 17 and 18. So on December 13th, we accepted a $9,500 note, 45 days, 8%, to Miranda Lee. So this is the same entry as what we just made in that previous problem. $9,500 debit to notes receivable and a credit to accounts receivable. And then our 18 days worth of interest is going to be our $9,500 times 8% times 18 divided by 360, or $38. We're going to recognize interest revenue. Then in 2018, we received Lee's payment for principal and interest on the note dated December 13th. So on January 27th, we're going to receive cash for the total principal and interest. So our note receivable is going to go away. In order to do that, we need a credit of $9,500. Our interest receivable for the 18 days is also going to go away, so we're going to credit that. And then we have our interest revenue for the remaining 27 days that we had computed a couple slides ago of $57. So the total cash that we're going to receive is that $9,595. Okay. Then on March 3rd, we accepted a $5,000 10% 90-day note to grant a time extension on a past due account receivable from Tomas Company. So we're going to record our note receivable with a debit of 5, and we're going to record our account receivable reduction with a credit of 5. Then on March 17th, we accepted a 2,030-day note for 9%, dated March 17th, to Hiroshi Chang for a past due account receivable as well. So same idea, debit note receivable, credit account receivable. Then on April 16th, Chang dishonors the note when presented for payment. So we're just going to put that back on our books. So we debit accounts receivable and we credit notes receivable. And then we also record the interest revenue of $2,000 or $15, 2,000 times 9% times 30 divided by 360. So the amount that he owes us now in our account receivable is not only the original balance that we granted him the extension on, but also the interest that's accrued, right? So then on May 1st, we wrote off the Chang account against the allowance for doubtful accounts. So we're going to reduce our allowance for doubtful accounts by $2,015, and we're going to reduce our account receivable by $2,015. Then on June 1st, Tomas payment is received for the principal and interest on the note dated March 3rd. So our cash received is going to be equal to our notes receivable that we're going to reduce because we've received the cash for it, the principal amount. And then we need to compute the total interest on that note, which is our 5,000 times 10% times 90 divided by 360. So we have interest revenue of $125, and they paid us both the principal and interest. So our cash received is going to be the total of the two, $5,125. Okay. All right, so same problem here. Why don't you pause the recording and take a few minutes, record the journal entries, and then when you think you're finished, you can resume the recording and we can go through the answers. All right, so our December 13th entry, we accept a $20,000 45-day 8% note. So we're going to record a note receivable for that $20,000. And we're going to reduce M. Lee's accounts receivable by $20,000 because they say they're giving her a note as an extension on her past due account receivable. Then on December 31st, we have to record the accrued interest. So how many days have passed from the 13th to the 31st? That's 18 days, right? So we have interest receivable of $20,000 times 8% times 18 days divided by 360. We're going to record interest revenue for $80. Then on the January 27th, we received the payment. So we're going to record cash. The cash is going to be equal to both the note receivable and the interest, right? So we're going to reduce our note receivable, which is $20,000. And we're going to reduce our interest receivable of $80 that we recorded at December 31st. And M. Lee is going to pay us. Then we also have to record our interest for the other 27 days that happened in 18. So we have interest revenue of $20,000 times 8% times the other 27 days. It's $120. So we're going to receive $2,200 total cash from M. Lee Company. Then on March 3rd, we accepted a $14,000 8% 90-day note. So we're going to record a notes receivable to Tomas Company for $14,000. We're going to record a reduction in the accounts receivable that Tomas had that is past due. We do that with a credit of $14,000. Then on March 17th, we accepted another $12,000 30-day note, 7%. So we're going to record a note receivable with a debit of 12. We're going to reduce Ching's receivable by 12 because it's an exchange for that past due receivable. Then on April 16th, Ching dishonors the note when it was presented for payment. So we're going to have to put that account receivable back, but we put it back at the principal plus the interest that's accrued. So the $12,000 note is going to be reduced. We do that with a credit. We record the interest, $12,000 times 7% times 30 divided by 360. So we're going to put an account receivable back on the books for $12,070. Then on May 1st, we wrote Cheng's account receivable off against the allowance. So we're going to debit our allowance account to reduce it because it's a contra asset account. So that's $12,070. And then we're going to reduce the account receivable balance by $12,070. And then on June 1st, we received payment from Tomas. So the note receivable for Tomas is going to be reduced to 0. We do that with a credit of $14,000. The interest for that note, all in the 18-year, 8% times 90 divided by 360 is $280. And we're going to record cash for $14,280. Okay? All right, exercise 713. The following are the selected transactions for the Vitello Company. So we accepted a 60-day, $6,180-day 8% note to grant Kelly White time to pay her past due account receivable. We have to adjust the year-end accounts for the accrued interest, and then we have to record the payment when we get it in the next year. All right, so first, complete the table below to calculate the interest amounts. So principal 6, rate of 8%, time is 180 divided by 360. So the total interest on the whole note is $240. The amount accrued at December 31st, so let's see, November 1st through December 31st, that's 61 days, right? So 6,000 times 8% times, isn't that 61 days? 30 days in November plus 31 days in December. They must not be counting the first itself. So that's 60 divided by 360. Oh, it's 360-day years, so each month is considered to be 30 days. So you have 30 days in November, 30 days in December, so $80. And then the interest recognized that April 30th is going to be the other 60 days, or other 120 days, sorry. So we have 60 times 8% times 120 divided by 360 for $160. So then our journal entries on November 1st, record the notes receivable, $6,000. Accounts receivable, credit of $6,000. Then on December 31st, we're going to record our interest receivable and our interest revenue for the amount that's accrued of $80. Then on April 30th, we're going to record the cash we received, which is going to be the sum total of the receivable principal, which is $6,000, the interest receivable that we recorded at the end of the year of $80, the current year interest, which is the $160 we computed above. So we're going to collect $6,240 of cash from Kelly White. All right, same problem here, different numbers. Why don't you take a few minutes and see if you can't get through it yourself, and then resume the recording and we can go through the answers. All right, so let's complete the table first. So the principal of $13,000 times the rate of 7 times 180 divided by 360 days. Total interest of $455. The amount accrued at December 31st is $13,000 of principal times 7% times 60 days divided by 360. Total of $152. And the interest recognized at April 30th is $13,000 times 7 times the other 120 days divided by 360 for $303. So then our journal entries, when we first give Kelly White the note, we're going to debit our notes receivable to increase it, and we're going to credit our accounts receivable to decrease it. Then to record our accrued interest at December 31st, we're going to debit interest receivable for that $152 related to 60 days worth of interest. Record our interest revenue of $152. And then on April 30th, we're going to record the cash collection, which is the sum total of the note receivable of $13,000, the interest receivable we had on the books at December 31st of $152, plus the interest revenue of $303 for the remainder of the time of the note that extended into the next year, that other 120 days, for a total of $13,455. Okay, hopefully you did well on that one. All right, 714. Prepare the journal entries for Ridge Company for the following transactions. March 21st, we accepted a $9,500 180-day 8% note from Tamara Jackson, granting her a time extension on her past due account receivable. So the first entry, we're going to record a note receivable for $9,500, and we're going to reduce our account receivable with a credit of $9,500. Then on September 17th, Jackson dishonored the note when it was presented for payment. So we're going to record our account receivable again, but this time it's going to be equal to the interest plus the original balance, right? So our note receivable was $9,500. We're going to remove that from our books, and we do that with a credit. We're going to record the interest revenue of the $9,500 times 8% times 180 days divided by 360, $380. And then we're going to put our account receivable back on the books for the original balance plus the interest, which is a total of $9,880. And then on December 31st, after exhausting all legal means of collection, Ridge Company decides to write off Jackson's account against the allowance. So we're going to reduce our allowance for doubtful accounts by $9,880, and we do that with a debit. And we're going to reduce our accounts receivable for $9,880. Okay? All right, same entry or same problem, different numbers. Why don't you take a minute to see if you can't walk through it yourself, and then resume the recording and we can go through it. All right, so on March 21st, we're going to record our note receivable. So note receivable to Jackson, $6,100 debit, and account receivable, we're going to reduce that balance, $6,100. Then when Jackson dishonors the note, we're going to put the receivable back on the books, We're going to put it back on the books at the original balance plus the interest that's accrued. So we have notes receivable for T. Jackson, credit of $6,100. We're going to get that off the books and put it back to account receivable. But we also need to record our interest revenue, which is $6,100 at 9% times 180 divided by 360. So that's $275. So the balance of our account receivable now goes from $6,100 to $6,375. Then on December 31st, when they exhaust all means of collection and they write it off, they're going to write it off against the allowance. So we're going to reduce our allowance with a debit of $6,375, and we're going to reduce our accounts receivable with a credit of $6,375. Okay, hopefully you did well on that one. Exercise 715. On June 30th, Petrov Company has $128,700 of accounts receivable. They sold $7,245 of merchandise that had a cost of $5. Sold $20,000 of accounts receivable, so on and so forth, and they want us to prepare the journal entries for each of the transactions, assuming the company uses a perpetual inventory system. All right, so on July 4th, when we sold the merchandise, we're going to record an accounts receivable, and we're going to record sales, right? We also have to record the cost of that merchandise. And so the way we do that is a debit to cost of goods sold and a credit to merchandise inventory for the cost that they tell us there in parens. Then on July 9th, we sold $20,000 of receivables to Main Bank with a 4% factoring fee. So we're going to reduce our receivables by the $20,000 we sold. We're going to have a factoring fee expense of 20,000 times 0.004, which is $800, which means the cash that we received was the net of the two, the 19,200. Okay. Then on July 17th, we received $5,859 cash from customers in payment on their accounts. So we record cash, increase it with a debit, and we're going to reduce the receivables for the amount we collected. And then on July 27th, we borrowed $10,000 cash from Main Bank, pledging $12,500 of receivables as security for the loan. So Main Bank gives us $10,000 cash, and we recorded notes payable for $10,000. Okay. All right, so one of the notes that they, if we ever, I guess what they're trying to illustrate here is if we ever pledge accounts receivable, they still sit on our books. They're just security for a loan, no different really than how a building would be security for a mortgage or a home would be security for a mortgage, right? If you don't pay the mortgage, they come take your home. You don't pay your car loan, they come take your car. Same idea. But what you're required to do under GAAP, the generally accepted accounting principle rules, is that you, in your notes to the financial statements, which is all the words that follow the all the financial statements with the numbers themselves, in the notes to the financial statements, they would have you make a note saying that the accounts receivable in the amount of $12,500 are pledged as security for a $10,000 note payable. Okay. All right, so same problem. Why don't you take a stab at it, and then you can resume the recording when you're done, and we'll go through it. All right, journal entries. So on June 4th, or July 4th, excuse me, we sold $9,240 of merchandise with a cost of $5,540. So we're going to record a debit to accounts receivable and a credit to sales. And then we're going to record our cost of goods sold. So that's $5,540, and we debit cost of goods sold to recognize that, and we credit our inventory. Then on July 9th, we sold $17,000 of receivables to Main Bank. So we're selling them in this case. So they are coming off of our books. So we're going to reduce our receivable by $17,000 with a credit. We have to record our factoring fee expense, $17,000 times 3%. And then the cash that we're actually receiving in exchange for selling those receivables is $16,490. Then on July 17th, we received $6,000 cash from customers in payment on their accounts. So we just record cash, and we reduce our accounts receivable by 6, right? Then on July 27th, we borrowed $8,800 cash from Main Bank. pledging $12,320 of accounts receivable as security for the loan. So really all we're recording here is the loan, right? So we get $8,800 cash, and we're going to have a note payable to Main Bank for $8,800. That's what our note to our financial statements would look like. Okay? All right, exercise 716. So the following information is from the annual financial statements of Rahim Company. Calculate the receivable turnover for year 2 and year 3. So accounts receivable turnover is net sales divided by average account receivable. So in year 2, we have net sales of $335,280. Our average account receivable is $41,400, which is the ending receivable balance, year 2, plus the beginning balance, which is really the same as the ending from year 1. So that's why they're pulling the $34,800 divided by 2. So it's 3,000 divided by 38,100, 8.8 times. And then in year 3, it's the 405,140 divided by 44,800 plus 41,400 divided by 2. So we have 405,140 divided by 43,100 for a total of 9.4 times. Okay. All right, same problem, different numbers. Why don't you take a stab at it and then resume the recording and we can go through the answer. All right, so net sales again, divided by average accounts receivable is how we calculate accounts receivable turnover. Year 2 is 331,000 in net sales, divided by our average inventory. So if you take your ending inventory at year 2 plus your ending inventory at year 1, which is the same as your beginning inventory at year 2, divided by 2, it's 331 divided by 25,350 for 13.1 times. Then in year 3, 400,000 divided by 29,000 plus 27,000 divided by 2, 400 divided by 28,100 is 14.2 times. Okay, guys, that's it for chapter 7. So as always, if you have any questions as you're working through the homework, please don't hesitate to reach out.